You earn a paycheck. You borrow to buy a home. You spend on goods you need. You save what's left over if there's anything left. 4 stages. 4 moments where you interact with the financial system, and at every single stage, the architecture was designed to extract wealth from you and transfer it upward. This isn't about a conspiracy. This is about incentives, institutional design, and power structures that evolved over centuries to do one thing: keep capital flowing toward those who already control it. Let me show you how each stage of your economic life was engineered to trap you, not by accident, by design. The earning stage, the borrowing stage, the spending stage, the saving stage. 4 gates you must pass through, and at each gate the system takes its cut, not through force, through structure, through mechanisms built into the financial architecture itself, mechanisms that feel natural, inevitable, like the way markets are supposed to work. But they're not natural, they were built. And once you see how, you'll understand why upward mobility keeps shrinking, why wealth concentrates, why the distance between you and financial security keeps growing no matter how hard you work. Let me give you the quick examples first, then I'll show you the historical structure. In 1802, France under Napoleon restructured its entire tax system to extract more from wages while protecting capital gains. The incentive wasn't equality, it was funding wars and the capital class that financed them. In 1913, America introduced the income tax the same year it created the Federal Reserve. Not a coincidence. You tax labor, not wealth, because labor can't leave. In 1971, wages and productivity decoupled. For 30 years, they'd risen together. After 1971, productivity kept climbing, wages flatlined. The difference went somewhere, to capital returns, to asset appreciation, to the top. In 1980, consumer credit exploded, not because people suddenly became irresponsible, because wage growth stopped and credit was offered as a substitute. Borrow to maintain your lifestyle. Pay interest forever. And in 1999, the financial system deregulated fully. Savings protections eroded. Speculation became standard. And every pension fund, every retirement account got tied to market risk. Your savings became their leverage. 5 moments, 5 structural changes, and every one of them made it harder for you to keep what you earn, easier for institutions to extract value at every stage. This is the pattern. And it didn't happen by accident. Let's start with earning, because this is where the trap begins. You work, you generate value, you get paid. Simple, right? But the structure of how you're paid and what's taken before you ever see the money is the first extraction point, and it was designed that way deliberately. In medieval Europe, taxation was direct and visible. A lord took a portion of your harvest. You saw it happen. You knew exactly how much was taken. The visibility created resistance. Peasant revolts were common because extraction was obvious. By the 17th century, states needed more revenue to fund standing armies and expanding bureaucracies. But direct taxation still triggered revolt. So they innovated. They started taxing transactions, goods, imports, indirect taxes. You paid, but it was hidden in prices. Less visible, less resistance. But the real innovation came in the 1800s with the rise of wage labor. Before industrialization, most people were farmers or tradesmen. They controlled their own production and sold their output. Taxation was difficult because income was irregular and hard to track, but wage labor changed everything. Factories employed hundreds of workers. They paid regular wages, and those wages were documented, recorded, trackable. For the first time in history, the state could see exactly how much you earned. Britain introduced income tax in 1799 to fund the Napoleonic Wars. It was supposed to be temporary. It became permanent. Why? Because it was efficient. The employer became the tax collector. You never saw the full value of your labor. The state took its cut before you got paid. This is called withholding, and it's the foundational mechanism of modern extraction. You don't pay taxes. They're taken from you before you can refuse. By 1913, the United States adopted the income tax. The 16th Amendment made it constitutional. But here's what they didn't tell you. The structure was designed to tax labor, not capital. Wages are taxed at higher rates than investment returns. Dividends, capital gains, interest income, all taxed lower than the money you earn from work. This wasn't an accident. The people designing the tax code were the capital class. They structured it to protect their income sources and extract from yours. And here's the mechanism that makes it inescapable. Wages are taxed at the source, You can't avoid it, but capital income is taxed on realization. You only pay when you sell, and if you never sell, if you borrow against your assets instead, you never pay. The wealthy borrow against stock portfolios, real estate, business equity. They live on borrowed money, and borrowed money isn't income, so it's not taxed. They pay interest, which is often lower than the tax rate would be, and they deduct the interest as a business expense. You pay taxes on your labor. They deduct the cost of avoiding taxes on their wealth. This is the structure of the earning stage. Labor is trapped, capital is mobile. The tax code extracts from the trapped and protects the mobile. And it's been that way for over a century, because the people who benefit from the structure are the people with the power to maintain it. Now let's move to borrowing, because this is where the trap deepens. You need a home, a car, an education. You don't have the capital, so you borrow. And the moment you borrow, you enter a contract that transfers wealth from you to the lender for decades. This isn't a normal exchange. It's an asymmetric relationship designed to keep you paying. Here's the history. Before the 20th century, borrowing was rare for ordinary people. Mortgages existed, but they were short-term, 5 to 7 years, and required massive down payments, 50% or more. Most people couldn't borrow, so they didn't. They rented or bought outright when they saved enough. But after World War II, the financial architecture changed. Governments wanted to expand home ownership, not for altruism, to create stability and stimulate construction, so they restructured lending. The 30-year mortgage was invented. The Federal Housing Administration insured loans, which reduced lender risk. And down payments dropped to 10%, then 5%, then, in some cases, 0. Suddenly, millions of people could borrow. Home ownership rates soared. This was sold as democratization. But look at the structure. A 30-year mortgage at 6% interest means you pay almost double the home's price over the life of the loan. On a $300,000 home, you pay $600,000 total. Half of your payments are interest wealth transferred from you to the lender. And here's the mechanism that makes it a trap. Mortgages are front-loaded with interest. In the first 10 years of a 30-year mortgage, over 70% of your payment is interest. You're barely touching the principal. So if you sell or refinance in the first decade, which most people do, you've paid tens of thousands in interest and own almost nothing. The lender has extracted maximum value. You've built almost no equity. Now scale this across the economy. Student loans, auto loans, credit cards. Every form of consumer debt is structured the same way. Interest heavy upfront, long repayment periods, and penalties for early payoff. The borrower is locked in. The lender extracts continuously, and the debt itself becomes an asset. Banks bundle mortgages into securities. They sell them to investors. Your monthly payment becomes someone else's income stream. You're not borrowing from a bank anymore. You're paying interest to a hedge fund, a pension system, an insurance company. The debt is commodified, and you're the product. Here's why this stage is critical to the trap. Borrowing was once rare. Now it's universal. Over 70% of Americans have mortgage debt. 60% have car loans. 45% have student loans. The majority of the population is in debt. And that debt generates interest, billions per year, flowing from borrowers to lenders. It's a continuous transfer. You work, you earn, and a portion of your earnings is committed, before you even see it, to servicing debt. You're not free, you're contracted to pay, and the system ensures you have to borrow. Wages haven't kept up with asset prices. The median home in 1970 cost 2.2 times the median income. In 2020, it's 5.6 times. You can't save fast enough to buy outright. You have to borrow. The structure forces you into debt, and once you're in, you're paying interest for 30 years. This is the borrowing stage, and it's the longest, deepest extraction point in your economic life. Now let's talk about spending, because even here, the system extracts. You earn money, you pay taxes, you service debt, and what's left, you spend on goods and services. But the structure of spending is designed to transfer wealth upward through two mechanisms: monopolistic pricing and inflation by design. Start with monopolies. In the late 1800s, America had a trust problem. Oil, steel, railroads, all controlled by single companies or cartels. They set prices. Consumers had no choice. The Progressive Era broke them up. Antitrust law was supposed to prevent monopolies and protect competition. It worked for about 80 years. But starting in the 1980s, antitrust enforcement collapsed. Mergers were approved at record rates, industries consolidated, and today, nearly every sector is dominated by a handful of firms. 4 companies control 85% of US beef production. 3 companies control 80% of baby formula. Companies own nearly every beer brand in America. This isn't competition, it's oligopoly. And oligopolies don't compete on price, they coordinate implicitly. Prices rise together. Consumers have no alternative. You pay what they charge. And here's the mechanism that makes it extraction. These companies are publicly traded. Their largest shareholders are asset managers: BlackRock, Vanguard, State Street. These firms own significant stakes in competing companies within the same industry. They own shares in Coca-Cola and Pepsi, in United and Delta, in Exxon and Chevron. This is called common ownership, and it removes the incentive to compete. Why would Coca-Cola undercut Pepsi on price if the same institutions profit from both? They don't. Prices stay high, profits stay high, and shareholders collect. You spend money on goods. The price includes a monopoly premium. That premium flows to corporate profits. Those profits flow to shareholders. And the largest shareholders are institutions managing wealth for the already wealthy. You're not just buying a product, you're funding their returns. Now add inflation. The central bank targets 2% inflation per year. That's official policy. Why? Because inflation erodes the value of cash and forces spending and investment. It keeps money moving through the system. But here's what they don't say. Inflation benefits borrowers and hurts savers. And the biggest borrower is the government. It borrows trillions. Inflation erodes the real value of that debt. But you, if you're saving in cash, lose purchasing power every year. 2% sounds small, but over 20 years, it cuts the value of your savings by a third. And inflation isn't evenly distributed. Housing, healthcare, and education inflate faster than wages. The things you need increase in cost faster than your income increases. The gap widens. You spend more of your income just to maintain the same standard of living. And what's left to save shrinks. This is the spending stage. Monopolistic pricing extracts at the point of purchase. Inflation erodes what you don't spend. And the structure ensures that your spending flows toward corporate profits, which flow to shareholders, which concentrates wealth. You're not just consuming, you're transferring. Finally, let's talk about saving, because this is where the trap closes. You've earned, paid taxes, serviced debt, and spent on necessities. What's left, if anything, you try to save. But the structure of saving is designed to turn your security into their speculation. Here's the history. In the early 20th century, savings were simple. You deposited money in a bank. The bank paid interest. Your money was safe, protected by the bank's capital reserves. But in the 1930s, after the banking collapse, the government introduced deposit insurance. The FDIC guaranteed deposits up to a certain amount. This restored confidence, but it also changed incentives. Banks could take more risk because depositors were protected by the government, not the bank's prudence. By the 1980s, deregulation accelerated. Banks were allowed to merge with investment firms. Commercial banking and investment banking, previously separated, combined. Your deposits, meant to be safe, were now on the same balance sheet as speculative trading. The firewall was removed, and then came the shift to market-based retirement. Pensions used to be defined benefit. Your employer promised a specific payout at retirement. But starting in the 1980s, companies shifted to defined contribution plans. 401ks, IRAs. You contribute. You manage the investments. You bear the risk. The employer's obligation is limited. This was sold as empowerment. You control your retirement. But here's the structure. Your retirement savings are now in the stock market, and the stock market is controlled by institutions. You don't pick stocks, you pick funds, and those funds are managed by BlackRock, Vanguard, Fidelity. Here your money goes. They vote your shares. You own the stock on paper, but they control it. And here's the mechanism. Your savings become their capital. They use it to buy influence, to consolidate industries, to fund leveraged buyouts. Your retirement account isn't just saving for your future. It's providing liquidity for their strategies. And when markets crash, you lose. Not them. They collect management fees regardless. In 2008, retirement accounts lost trillions. Asset managers kept collecting fees. The risk was yours. The fees were theirs. Now scale it. Over $30 trillion in retirement assets in the United States. All of it in the market. all of it managed by a handful of institutions. Your savings aren't safe, they're deployed, and the returns you get are what's left after fees, after inflation, after market volatility. The institutions take their cut first. You get the residual. This is the saving stage, and it's the final transfer. You work your entire life, you save what you can, and that savings is turned into capital for institutional strategies. You bear the risk, they take the returns, and when you retire, if your account has grown, it's not because the system rewarded you, it's because you survived the volatility they created. Let me pull it all together. Earning. Wages taxed at the source, capital taxed on realization, labor trapped, capital mobile. Borrowing. Debt structured to extract maximum interest upfront, repayment stretched over decades, the borrower locked in. Spending. Monopolistic pricing inflates costs. Inflation erodes purchasing power. Your spending becomes their profit. Saving. Your money turned into their capital. Market risk transferred to you. Management fees extracted regardless of performance. 4 stages, 4 mechanisms, and every one of them was designed through policy, through institutional structure, through financial innovation to ensure wealth flows upward. Not because of individual greed, because of systemic incentives. The institutions that control finance, that lobby for tax policy, that merge into monopolies, that manage your savings, they benefit from the structure. And the structure is self-reinforcing. The more wealth concentrates, the more power to shape policy, to maintain the mechanisms, to prevent reform. This isn't about villainy. It's about incentives. A bank has an incentive to maximize interest collection. A corporation has an incentive to minimize competition. An asset manager has an incentive to gather assets and charge fees. A government has an incentive to tax the immobile and protect the mobile, because the mobile can leave and take their capital with them. Each actor is optimizing for their position. And the result is a system where every stage of your economic life is an extraction point. And here's the key. The system doesn't need a conspiracy. It doesn't need a hidden cabal designing everything. It just needs incentives. Once the structure is in place, they perpetuate. Banks will keep front-loading interest. Corporations will keep consolidating. Asset managers will keep gathering your savings. Tax policy will keep favoring capital. Not because someone is pulling strings, because that's what the structure rewards. Now let me show you how this plays out today, right now in your life. You get a job. Your wages are taxed at 20, 25, maybe 30% depending on your bracket. You take home 70 to 80% of what you earn. Someone living off investments pays 15% on long-term capital gains, and if they're sophisticated, they borrow against assets and pay 0. You're already behind. You need a home. You borrow $400,000 at 6% over 30 years. Your monthly payment is $2,400. Over 30 years, you'll pay $864,000 total. The bank collects $464,000 in interest. That's more than the home cost. And in the first 15 years, you've barely reduced the principal. If you sell, you walk away with minimal equity. The lender has extracted the maximum. You spend on groceries, gas, healthcare. Grocery prices are set by a handful of conglomerates, gas prices by a handful of oil companies, healthcare by a system where insurers, pharmacy benefit managers, and hospital networks are all consolidated and vertically integrated. You have no bargaining power. You pay the price they set. And that price includes a premium that flows to shareholders. You save in a 401k. You contribute $500 a month. It goes into a target date fund managed by Vanguard. Vanguard charges a 0.15% fee. Seems small, but over 30 years on a $500,000 balance, that's $75,000 in fees. You bear all the market risk. Vanguard gets paid regardless. And if the market crashes right before you retire, you lose 30% of your balance. Vanguard's fees don't stop. 4 stages, 4 extractions, and by the time you reach retirement, you've paid hundreds of thousands in taxes, hundreds of thousands in interest, tens of thousands in monopoly premiums, and tens of thousands in fees. What's left is what you retire on, and the system calls this normal. Here's what this means for you. The structure isn't going to change because you work harder. It's not going to change because you're more disciplined with money. The mechanisms are embedded, the institutions benefit, and the political system is funded by the same institutions that profit from the structure. Reform is theoretically possible, but structurally unlikely, because the people with the power to change the system are the people who benefit from it. So what do? You can't opt out entirely. You have to earn, you have to spend, you probably have to borrow, and you need to save. But you can see the structure. You can understand where the extractions happen. You can minimize them where possible. Pay off debt faster to reduce interest. Avoid lifestyle inflation to reduce spending on monopolistic goods. Keep fees low by choosing index funds over actively managed accounts. Structure your income, if possible, to capture capital gains rather than ordinary income. But more importantly, you can recognize the pattern. When politicians talk about tax reform, ask who benefits. When corporations merge, ask what happens to prices. When financial products are marketed as empowerment, ask who bears the risk and who collects the fees. The system is designed to obscure the extractions. Your power is in seeing them clearly. And here's the final truth. The system isn't broken. It's working exactly as designed. Wealth concentrates, power consolidates, and each generation finds it harder to climb. Not because people are less capable, because the ladders were removed and replaced with escalators going down. You're not failing. You're running against a structure built to transfer wealth upward. The 4 stages of your economic life, earning, borrowing, spending, saving, were designed over centuries through policy evolution, financial innovation, extract value from labor and concentrate it in capital. The designers weren't villains in a smoky room. They were bankers optimizing profit, corporations maximizing shareholder returns, policymakers responding to lobbying, asset managers gathering fees, each rational actor in their position. And the result is the system you live in now. If you finally understand why home ownership feels out of reach, why wages don't go as far, why retirement seems uncertain, even when you do everything right, then you're starting to see the machine. It's not your fault, it's not bad luck, it's the structure, and the structure was built to trap you. Subscribe if you want to keep seeing how the architecture of power actually works, not the stories they tell you in school, not the myths about free markets and equal opportunity, the real mechanisms, the ones that shape your life every single day. Because they're not going to explain this to you, they're going to tell you to work harder, save more, make better choices. But the structure doesn't care how hard you work. It extracts either way, and the only defense is seeing it clearly. 4 stages, 4 traps, 1 system, and it was built long before you were born.